The greatest fortunes and most catastrophic failures on Wall Street are fundamentally rooted in 5 mathematical concepts, not merely in the ebb and flow of human greed or fear. These concepts are not hidden formulas locked away in a vault, but are models whose fundamental limitations the financial industry has consistently chosen to ignore or dangerously oversimplify. The shift from intuitive, gut-feeling trading that dominated the pre-1950s era to the subsequent quant revolution marked a pivotal change in how risk and reward were perceived. This revolution attempted to quantify the unquantifiable, transforming market dynamics into a series of equations and probability distributions. However, the true secrets lie in the dangerous assumptions baked into these models, assumptions that hold true only until the moment they are most desperately needed. Understanding these 5 mathematical secrets is the only way to truly comprehend the mechanisms of financial delusion and the true nature of market risk. The first essential mathematical secret involves the illusion of perfect diversification, a concept central to modern portfolio theory. This groundbreaking theory, developed by Harry Markowitz in 1952, provided the mathematical framework for optimizing a collection of assets. The core promise of modern portfolio theory is the ability to construct a portfolio that sits on the efficient frontier, offering the maximum possible return for any given level of risk. It suggests that combining assets whose movements are not perfectly synchronized can smooth out volatility, delivering a better risk-adjusted return than any single asset could achieve alone. This framework requires an input called the covariance, which is a mathematical measure of how 2 different assets move in relation to one another. The theory posits that as long as assets are not perfectly positively correlated, diversification works to reduce overall portfolio risk. The hidden secret, the risk that Wall Street often conveniently forgets, is that this correlation is not static but dynamic. Modern portfolio theory relies on the assumption that the historical correlation between assets will persist into the future. The crucial flaw is that during a systemic crisis, such as a credit crunch or a global pandemic, all correlations tend mathematically toward positive one. This means that when the market is under maximum stress and investors most rely on diversification, all assets begin to move in lockstep, collapsing simultaneously. Diversification, the very mechanism designed to protect the portfolio from maximum loss, completely fails exactly when its function is most critical. This is the moment when the mathematical model breaks down under the weight of real-world financial panic and interconnectedness. The initial reception of Markowitz's work was met with significant hostility from the old guard of Wall Street, the traders who relied on intuition and market lore. They saw no need for complex equations to tell them how to choose stocks or how to spread their bets across different industries. The mathematical approach was perceived as academic and impractical, an ivory tower exercise with no place in the rough-and-tumble world of actual trading. Yet the sheer elegance of the efficient frontier eventually forced its slow but inevitable adoption, becoming the foundation for most institutional investment management. The shift was less about finding a perfect solution and more about adopting a common language for discussing and, more importantly, selling the concept of controlled risk. The history of finance is filled with examples where seemingly uncorrelated assets suddenly converged during a panic. For instance, in a severe liquidity crisis, even traditionally safe assets like high-grade corporate bonds can plummet alongside equities, defying their historical inverse relationship. This simultaneous collapse exposes the entire portfolio to a level of loss. The modern portfolio theory model was mathematically designed to prevent. The model provides a clear quantitative map for risk management in normal times, but it completely obscures the catastrophic risk inherent in the system during extraordinary times. Therefore, the secret is not in the formula itself, but in the reckless belief that a historical correlation coefficient can ever predict the behavior of human panic. Before we delve deeper into the mathematical concepts that have shaped and occasionally shattered the financial world, it is crucial to establish a connection with you, the viewer. This kind of content, which breaks down complex financial history and mathematics into practical lessons, relies on your engagement to reach a wider audience. Please take a moment right now to subscribe to the channel and leave a quick comment, even if it is just a single word like correlation or quant. This simple action greatly helps the algorithm recommend this video to more people and shows us that this kind of content truly matters and is worth the extensive effort required to create it. Moreover, please do not forget to return to the channel during challenging times when trading becomes difficult and your confidence starts to waver, as the lessons hidden here are timeless. The second mathematical secret concerns the fatal flaw embedded within the Black-Scholes Merton option pricing model, a formula that revolutionized Wall Street in 1973. This model provided, for the first time, a theoretical fair price for derivative contracts, specifically European-style options. Its introduction allowed traders to move from speculative guesswork to a calculated, mathematically derived value for complex financial instruments. The greatest promise of the model was the concept of dynamic hedging, which suggested that by continuously adjusting a portfolio of the underlying stock and the option, a trader could virtually eliminate the risk inherent in the option trade. Essentially, the model made risk appear controllable, transforming options trading from a high-stakes gamble into a sophisticated form of mathematical arbitrage. The hidden secret, the fatal flaw, lies in the model's fundamental and unrealistic mathematical assumptions about the real world. The Black-Scholes Merton model assumes that volatility is constant over the life of the option, which is an assumption demonstrably false in any real market. It also assumes that stock prices follow a log-normal distribution, meaning that extreme market moves, both up and down, are highly improbable and should occur only rarely. This log-normal assumption mathematically underestimates the probability of fat tail events, which are the large, sudden market shocks that define financial crises. The Wall Street secret is that the market rarely uses the formula to calculate a price in the theoretical sense. Instead, traders use the observed market price to calculate implied volatility. Implied volatility is the market's collective guess at future risk, derived by running the Black-Scholes Merton formula in reverse. This turns a theoretical pricing tool into a practical trading instrument, allowing market participants to bet on future risk itself. However, by using the model in reverse, they do not negate the mathematical fragility inherent in its assumptions. They simply choose to ignore them. When a major market event occurs, the real-world volatility and the sudden non-log normal price jumps violate the model's core mathematical principles. The result is a sudden catastrophic breakdown in the dynamic hedging strategies that depend on the model's smooth, predictable path. The most spectacular and cautionary story illustrating this failure is the 1998 collapse of long-term capital management. This was a hedge fund founded by financial theorists Myron Scholes and Robert Merton, who were awarded the Nobel Prize for their work on the option pricing model. Long-term capital management strategy was based on complex mathematical arbitrage bets that relied heavily on the model's assumptions about correlation and volatility remaining stable. Their models suggested that the convergence of bond prices, for example, was a near certainty, and they leveraged their bets to an extreme degree to magnify the small, mathematically derived edge. When the Russian debt crisis hit, the real-world correlation of seemingly disparate global assets suddenly spiked, violating their models. The mathematical arbitrage bets failed catastrophically when volatility exploded and correlations moved violently against their predictions. The fund was leveraged to a ratio of over 25-1, meaning a small percentage loss in their total assets wiped out their entire capital base. The collapse of long-term capital management was not a failure of human greed, but a failure of mathematics respected too rigidly, a failure of believing the model's theoretical certainty over the market's real-world chaos. It proved that even the most brilliant mathematical minds cannot escape the consequences of building a highly leveraged strategy on top of fragile, unrealistic assumptions. Their story serves as a permanent testament to the danger of mistaking a mathematical approximation for absolute financial truth. The third mathematical secret revolves around the value at risk, or VAR, trap, a metric that became the standard for firm-wide market risk in the 1990s. Value at risk was designed to answer a seemingly simple but critical question for financial institutions. What is the maximum amount of money we could possibly lose over a specific time horizon with a given level of confidence? For instance, a bank might calculate a one-day value at risk of $10 million at a 99% confidence level. This means the bank expects to lose no more than $10 million on any given day, 99% of the time. The promise of value at risk was that it provided a single, easily digestible number that senior management and regulators could use to monitor and manage the vast, complex risks across an entire organization. The hidden secret, the trap, is that value at risk systematically underestimates the very risks that lead to financial collapse. Like the Black-Scholes Merton model, value at risk's most common calculation methods rely on the assumption of a normal distribution for asset returns, a bell-shaped curve. This reliance means that the model systematically ignores or downplays the probability of tail risk, which are the extreme events that lie outside the standard deviation of the curve. Value at risk is excellent at measuring risk under normal market conditions, but it becomes mathematically irrelevant precisely when conditions turn abnormal. The secret is that value at risk tells you absolutely nothing about the magnitude of the loss. If the confidence threshold is breached, if the 99% confidence level is breached, the loss could be $10,001,001, or it could be $100 billion. Value at risk provides no mathematical distinction between these two outcomes, creating a false sense of security regarding the potential for catastrophic loss. This creates a perverse incentive, as traders are encouraged to structure their positions so that the risk is moved just outside the 99% confidence interval, where the metric can no longer see it. This is known as risk migration, where the most dangerous exposures are mathematically hidden from the firm's primary risk management tool. The use of value at risk essentially trained the industry to be prepared for the most common events, while remaining utterly blind to the most consequential ones. The 2008 financial crisis serves as the definitive tragic case study of the value at risk trap in action. Institutions across the globe were relying on value at risk to manage their exposure to complex assets like mortgage-backed securities and collateralized debt obligations. Their models, based on short-term historical data from a period of relative calm, consistently reported low value at risk numbers for these assets, suggesting minimal downside risk. When the housing market collapsed, the actual losses were orders of magnitude greater than what the value at risk models predicted, completely blindsiding the institutions that trusted the metric. The severity of the losses outside the confidence interval, the true black swan event, was simply not accounted for in their mathematical framework. The failure was a direct result of relying on a mathematical tool that defined risk too narrowly, confusing volatility with actual exposure value at risk. By focusing only on the maximum expected loss in a normal environment, gave institutions a dangerous permission slip to take on extreme tail risk. The crisis exposed the fundamental truth that a risk management tool is only as good as its underlying assumptions about market behavior. When those assumptions are mathematically flawed, the entire financial system built upon them becomes dangerously brittle and prone to sudden violent collapse. The lesson is that measuring risk is not about drawing a line at a 99% confidence level, but about understanding what happens in the 1% of the time that truly matters. The fourth mathematical secret is the formula that exposed a massive financial fraud, centered on the metric of the Sharpe ratio and the promise of unnatural return consistency. The Sharpe ratio, developed by Nobel laureate William F. Sharpe, is a measure of risk-adjusted return, calculated by taking the average return earned in excess of the risk-free rate and dividing it by the standard deviation of that return. A higher Sharpe ratio is mathematically superior, indicating that an investment is generating more return for each unit of risk taken. Bernie Madoff promised his investors steady, high returns, often around 10% annually, with shockingly minimal volatility, suggesting an exceptionally high, almost impossible Sharpe ratio. The hidden secret that mathematically exposed Madoff was the statistical impossibility of his reported returns being generated by his claimed split-strike conversion strategy. Madoff's returns were not just high. They were too consistent, displaying a statistically unnatural smoothness that defied the chaotic nature of the real stock market. The whistleblower, Harry Markopoulos, used simple mathematics to prove that a real trading strategy, especially one involving options, cannot produce such a statistically perfect, low-volatility return stream. He noted that Madoff's fund only reported 4 down months over a 7-year period, compared to 28 down months for the S&P 500 index during the same time. This level of consistency is mathematically inconsistent with any legitimate options trading strategy. Markopoulos's initial analysis, which took him only 4 hours, concluded with absolute certainty that Madoff's numbers were a fraud. The mathematical proof was based on the simple observation that such a high Sharpe ratio with such minimal volatility cannot exist in a real liquid market. The true secret of the Madoff fraud was not a complex hidden formula, but the simple mathematical reality that perfect consistency is the ultimate warning sign of fabricated reward and hidden risk. Real trading involves volatility, drawdowns, and the occasional bad month. And any strategy that claims to eliminate this natural market behavior is mathematically suspect. The consistency of Madoff's returns was not a sign of genius. It was the mathematical signature of a Ponzi scheme. Markopoulos also used simple mathematical facts about the options market to further prove the impossibility of Madoff's claims. Madoff claimed to be executing a massive volume of options trades to hedge his portfolio, but Markopoulos calculated that the claimed volume was simply impossible given the size and liquidity of the options market at the time. The sheer scale of the trades Madoff claimed to be making would have left a massive, undeniable footprint in the market, a footprint that investigators could never find. The mathematical evidence was overwhelming. The claimed returns were too consistent, the purported trading volume was too large for the market to bear, and the resulting Sharpe ratio was too high to be real. This entire fraud was exposed by a straightforward mathematical analysis of statistical anomalies. The ultimate lesson of the Madoff scandal is that investors should fear mathematical perfection far more than market volatility. Volatility is the natural price of market participation, but perfect, low volatility consistency is a statistical impossibility that can only be achieved through fabrication. The Sharpe ratio, designed to measure risk-adjusted performance, was ironically the very metric that, when taken to an extreme, signaled the fraud. It proved that a fundamental understanding of market mathematics is the most effective defense against sophisticated financial deception. The secret is that the numbers themselves rarely lie, but people lie about the numbers, and the mathematical inconsistencies are the only true evidence needed to uncover the lie. The fifth and final mathematical secret concerns the power of compounding tiny edges, exemplified by proprietary quantitative algorithms like those used by Renaissance Technologies' Medallion Fund. The Medallion Fund has generated astronomical, almost unbelievable returns, achieving total returns of over 39 million% since its inception, seemingly defying the efficient market hypothesis. This hypothesis suggests that all available information is already reflected in asset prices, making it impossible to consistently achieve returns above the market average. The Medallion Fund's performance, characterized by high returns and remarkably low volatility, suggests a mathematical edge that completely decouples its risk and reward profile from the overall market. The secret of this phenomenal success is not a single revolutionary formula, but the calculated surgical use of extreme financial leverage to magnify the returns from millions of tiny, statistically proven market inefficiencies. This strategy is known as statistical arbitrage, where complex algorithms identify minute, temporary mispricings between related financial instruments. These mispricings, which might only offer a fraction of a percent in profit, are too small for human traders to exploit profitably. The Medallion Fund reportedly uses leverage as high as 50 to 1, meaning every dollar of their own capital controls $50 of assets. This leverage is not used to take massive directional bets on the market, which would be catastrophically risky. Instead, the extreme leverage is applied to magnify the millions of tiny, statistically proven edges identified by the algorithms. The risk is carefully capped by the small size of each individual trade relative to the total assets under management. Each trade is a small, high-probability bet that, when aggregated and compounded over time, results in an astronomical rate of growth. If one or two of these tiny bets fail, the loss is negligible due to the small position size. The mathematical edge is derived from the sheer volume and statistical certainty of the trades, allowing for high compounding growth without catastrophic single-trade exposure. The power lies in the aggregation of small, statistically independent bets. The true genius of the strategy is its ability to remain market neutral, effectively removing systematic market risk from its profit-generating equation. The Medallion Fund generated significant positive returns even during the 2000 dot-com crash and the 2008 financial crisis, periods when the overall market was collapsing. This demonstrated a mathematical edge that was completely decoupled from the overall economic cycle and the general market direction. Their profits came from the consistent exploitation of relative pricing differences, not from betting on whether the market would go up or down. This reliance on statistical arbitrage, rather than economic forecasting, is the fundamental mathematical difference that separates their success from traditional investing. The secret is a testament to the power of mathematics and high-speed computing to find and exploit the limits of market efficiency. It shows that while the market may be efficient on a large macro scale, it is riddled with millions of tiny, fleeting inefficiencies that can be systematically harvested. The mathematical principle at work is the law of large numbers, where the aggregation of a massive number of small, independent, positive expected value bets results in a predictable high-return outcome. This final secret is not about avoiding risk entirely, but about using mathematics and technology to transform systemic market risk into a manageable series of statistically isolated, independent risks. The 5 mathematical secrets we have explored reveal a profound truth. True financial risk is not the simple volatility of a single asset, but the inherent, often unstated assumptions embedded in the models used to measure it. Modern portfolio theory fails when correlation goes to 1. The Black-Scholes Merton model fails when volatility is not constant, and value at risk fails when the distribution is not normal. The greatest reward in finance comes not from finding a hidden magic formula, but from understanding the mathematical limits and fragility of the formulas that currently govern the market. A successful investor or trader must be a skeptic of the model, not a true believer. The ultimate lesson Wall Street hides is that every formula is an approximation, a simplification of a chaotic reality, and the moment a formula is treated as an absolute truth is the moment risk becomes unmanageable. The greatest financial catastrophes were not caused by a lack of data or a lack of models, but by an over-reliance on models that failed to account for the catastrophic tail risk. The journey to financial mastery is not about memorizing equations, but about mastering the mathematical context in which those equations are applied. The financial world is constantly evolving, but the core human psychology and the mathematical principles that govern risk remain constant. For those who seek to deepen their understanding of trading psychology and the timeless strategies of market legends, we have a highly recommended resource. Before we offer a final thought on these mathematical secrets, consider the enduring wisdom found in the new edition of Reminiscences of a Stock Operator. This classic work by Edwin Lefebvre offers a deep, unparalleled analysis of the psychology and strategies of the legendary trader Jesse Livermore. The new edition transforms his historical experience into practical, actionable lessons for contemporary traders, complete with unique commentary and detailed analysis for every chapter. It teaches you the psychological side of risk, which no mathematical model can ever fully capture. You can find the link to this essential classic in the description below and begin translating the lessons of the past into the profits of your future. The only sustainable edge in finance is a superior understanding of the limitations of quantitative tools. Understanding the mathematical limits of the formulas that govern the market is the final, most crucial secret to financial success.